So welcome back guys to Lofi-Ledger. Today we're going to talk about how do you quantify the drawdown and psychologically prepare yourself for the different types of volatility in the crypto market, right? So one big mistake people make is they're usually blinded by the amount of gains that they can make in crypto or in different markets, but they really fail to take into account what is the potential drawdown that my portfolio will experience. Because that's one of the biggest things in investing, right? If you're gonna get 100x gain, you're probably gonna have like 90% drops. And you need to quantify what kind of risk you personally want to experience, right? Because it's not easy to sleep at night if your entire life savings went down 80%, right? So here, we'll try to quantify what to expect when you invest in Bitcoin, ETH, or different kinds of markets, and use that as a psychological preparation for when these moves actually do happen. And we can also use this to see if we are actually in the bottom or not. So let's go into this. How does this work? So this is a chart that I made for you guys in Lofi-Ledger.com. So how this works is if I take any point in this chart, so for example here, February 27, 2017, Bitcoin was at $1,190, right? So 1.19K. So any point in this top graph is the price of Bitcoin. So, and the bottom graph is actually the worst drawdown that you would have experienced if you had been invested for already a year. So for example, here in December 28, 2016, when Bitcoin was at $900, if you had invested since the prior year, 2015, then the worst drawdown that entire portfolio would have experienced was around 29%, right? So that's how this works. So now you can see that this bottom chart is basically the worst drawdown any portfolio experienced in a trailing 1 year period, right? So this gives us an idea on what kind of drawdowns people experience. So for example, in 2015, if you had already been in the crypto market for a year, you would have come from these highs, right? So the worst drawdown you would have experienced is around 70%. Versus if you had invested in December 4, 2017, if you had already been invested for a year, you would have been experiencing all of these gains, and the worst drawdown that you would have experienced was only 35%. But that's still 35%, right? Traditional markets only fall like 10, 20%. And that's already huge, right? Crypto, during this massive bull run where everything was going up for months, if not years, still had a 35% drawdown, right? So if you saw your portfolio going down by 35% during that bull run and then sold it, you would have failed to capitalize on that huge gain, right? So at least this kind of quantifies what kind of drawdowns to expect in crypto, right? So the best case scenario here actually is a 20% drawdown. If you're invested in crypto for at least a year, at best, you would only experience a 20% drawdown, right? So the bottom part here is actually statistics on this chart. So given that these are all of the drawdowns, what is the percentile of people that experienced a 53% drawdown, right? So what this is basically saying is that 50% of all portfolios that were invested in at least 1 year time frame experienced at least a 53% drawdown. So at least half of the people who invested for at least a year randomly throughout the years experienced a 53% drawdown, right? And the worst drawdowns like 83%, and the best case was around 20%. So if you're trying to invest in crypto and not expect to see your portfolio go down, you're going to be sadly disappointed, or you might end up panic selling when these are just normal volatility for this particular asset class. Different asset classes have different volatility, and this is what you can expect from crypto. At best, you might come out at 20% drawdown, but currently, throughout all of this, at worst, you're going to experience around, an 80% drawdown, and at least half will experience a 53% drawdown. So that's basically how you read these charts. It gives you an idea on how to prepare for the market. This can also sort of be used as an indicator. So For example, in January 27, 2015, the worst drawdown was around 78%. The next cycle was around 80%, and then the previous cycle was only around 72%. So you can see almost all of these cycles ended at a 70% drawdown, right? This cycle, our worst drawdown so far, is only 49%. So this kind of says that there's still more room to go down, right? Because past few cycles, we went down like 70, 80%. This time, we're only at 49%. It still seems like there's going to be some downside that we aren't accounting for. And if you're not invested at all in any assets, you can actually use this to get a glimpse of other asset classes. So for example, gold, the worst drawdown for gold was, since the 1980s in a 1-year time frame, was 54%. So that's still pretty big, right? But on average, 50% of all portfolios that invested in gold in a 1-year time frame only saw their worst drawdown to be 15%, right? So that's, almost a 5x difference from Bitcoin at like 53%, right? So if you're investing in gold, you can expect less drawdowns. And that's also how people balance their portfolio. What is the amount of risk or volatility that you can realistically stomach? So, when you're sleeping at night and seeing your portfolio down 15%, that's probably not that hard compared to, if you're all in 100% on Bitcoin and seeing it down 50%, right? So you can use this to get an expectation of how different 1-year periods, have different drawdowns. So this also for stocks. Stocks, the worst one was around 56%, and the median is 13%, right? So interestingly enough, 50% of people experience less volatility or less maximum drawdown from stocks than gold. And Ethereum is even more volatile than Bitcoin. The worst one was 94%. And at least 50% of people experience at least a 61% drawdown. So that's basically how these graphs work. We also have the gains here, so you can toggle gain to see how much gain. So obviously, since Bitcoin and ETH have more volatility, they also have higher upsides. Like why would you invest in an asset that just goes down, right? The reason why people are in crypto is because it has these huge spikes upwards. So for example, the best gain for Bitcoin was like 2,000%, and at least 50% of people in a 1-year time frame experienced 168% gain, right? Versus if you look at gold, 50% of people only experienced a 24% 1-year gain, right? So, it's huge. It's a huge difference in terms of gain and drawdown, but I do want to pay special attention to the drawdown because most people are too focused on how much their portfolio is going to grow when a big portion of investing is protecting your money and psychologically preparing yourself for days where the market isn't doing well. Because it's easy to see your money go up. It's not too easy to see it go down. But if you know that these are normal volatility numbers, then it becomes a bit easier because you're prepared and you have information knowing that these drawdowns aren't the end of the world, right? So that's basically how these charts work. If you guys want to get these charts, again, it's at Lofi-Ledger.com. These are completely free. And yeah, if you're interested in this videos, like and subscribe, and I'll see you next time. Peace.